In this session, we're going to be looking at a brand new set of taxes for you to learn about at ATX, which has not been examined at all at the applied skills level. These are called stamp taxes. It's a very small area of the syllabus, worth between 0 and 3 marks in the exam. But how many people have you heard of who get 49 in the exam? Maybe these 1 or 2 marks could turn a fail into a pass. We will be covering 3 stamp taxes: stamp duty reserve tax, and stamp duty land tax. Each of these could be payable by individuals or companies, so you can see that the examiner could easily squeeze this topic in anywhere in the exam. Stamp duty and stamp duty reserve tax are taxes on shares and securities. SDLT is a tax on land and buildings. You'll have access to some details in the exam on these: the rates and the thresholds for SDLT and the rate for stamp duty, which is also actually the same rate as for SDRT. Let's first look at stamp duty and stamp duty reserve tax because they're very similar to each other. Stamp duty is applicable on the transfer of already existing shares and securities when they are transferred by a formal written document such as a stock transfer form. Don't worry about this form, you're not expected to know anything about it, just memorise the name. SDRT, on the other hand, applies when the transfer happens without a written document and instead everything is done electronically, and in the UK this is done via the CRESS system. Now, how stamp taxes are administrated is not examinable, so we won't be going into any more details on that. Now, there are lots of similarities between these 2 taxes which will hopefully help you to memorise the rules a bit more easily. In both cases, the tax doesn't apply to newly issued shares, so it will only apply to shares that are now being bought and sold in the market. The taxes are payable by the purchaser, not the seller, which is quite unusual for the UK tax system. The tax in both cases is based on the consideration value of the shares or securities, which might not be the same thing as its current market value, so do be careful to only use the consideration value. Consideration can be money or money's worth if, say, someone is swapping an asset for the shares. Now, if the consideration can't be determined for sure at the time of the transfer, then they need to use an estimated value. This can be because the shares could be based partly on a fixed amount and part conditional on, say, the future performance of the company and its share value. HMRC has to be told of the final figure when it's eventually known, and any over or underpayment of tax will be settled then. And also make sure to include VAT in the consideration where relevant, even if the purchaser is able to claim that VAT back from HMRC, it doesn't matter. And finally, the rate of tax is the same for each tax, being 0.5%. Now for the differences. Stamp duty is charged on the date the transfer document is signed, whereas stamp duty reserve tax will be paid when the agreement to the transfer is made. So there is a slight difference in the wording of the rules there to watch out for. Another key difference is that although the rate of tax is the same, being 0.5%, with stamp duty we round up to the nearest £5, and with SDRT we round to the nearest pence up or down. It is a small difference, but it is important to remember. The way I was taught to remember the more unusual rounding rule for the stamp duty was that it was a really old tax, which it is. It's the oldest of all the stamp taxes. And imagine that you're paying it to an old man who doesn't have much in the way of change to give you, so all he's got is grubby £5 notes. It certainly worked for me in helping me remember it anyway. Now, finally, with stamp duty only, if there is consideration of £1,000 or less, then there is no stamp duty to pay. This rule does not apply to SDRT. Remember, it works electronically, so there's less administrative burden in collecting it. Let's look at an example together. We've got Jared here who sells his shares in Isaac Limited to Caleb for £74,831 and we're being asked to calculate the amount of stamp duty payable and state the person liable to pay it. So we know the rate is 0.5%. We multiply that by the 74,831. That gives us £374.155. So we need to remember our rounding rule. Stamp duty, very old tax. We round up to the nearest £5. Caleb is the purchaser. Stamp duty has to be paid by the purchaser, not the seller. So Caleb has to pay the £375. Now what about this example? We've got Benji selling shares in Gribbons Limited to Erica for 74,831, but this time it's via the CREST system. We are being asked to calculate the amount of stamp duty reserve tax payable and state the person liable to pay it. So again, we're 0.5% on the 74,831. The rounding is different this time. Remember, stamp duty reserve tax is electronic. Therefore, the rounding is done to the nearest pence up or down. So we're going 374.16. Erica, the purchaser, needs to pay the stamp duty reserve tax on that. Now let's have a look at the third stamp tax, which is stamp duty land tax, SDLT. Now, if you're based in the UK, you may have heard people refer to this tax, but they'll likely just have called it stamp duty. Now, you've seen now that stamp duty is actually a completely separate tax to SDLT. SDLT for your exam is only going to apply on the transfer of land and buildings and only within England and Northern Ireland. If the exam question doesn't mention a geographic location or whether it's residential or not, you should just assume it is a non-residential property located in England or Northern Ireland. The tax is payable by the purchaser, just like we saw with the other stamp taxes, and it's based on the VAT inclusive consideration for the property, even if the purchaser can recover the VAT on the purchase. And also the rate is based on whether it's residential or non-residential or mixed. But in the ATX exam, you're only going to be examined on non-residential properties, and you're given some information in the tax tables in the exam to help you should you have to do a computation. Now, you should note that this tax is one where you get charged one rate on the value up to a certain point, and then the next rate on the next chunk of the value, and then so on above that. This is what we call a stepped tax. Scotland no longer uses SDLT, and the thresholds in Wales are different. You should just be familiar with the thresholds given to you in the tax tables and apply them to any relevant scenario. So in this example, we've got Michelle purchased a shop for £210,000 and a warehouse for £140,000. And we're being asked to calculate the amount of stamp duty land tax payable and state the person liable to pay it. So if we look at our shop first of all, the first £150,000 is taxable at 0%, and then because this is a step tax, the next chunk above the threshold of £150,000 is taxable at 2%, the next rate. So that means a total of £1,200 of SDLT on that purchase. The warehouse, the consideration being £140,000 was no more than £150,000, so all of its price is taxable at the first rate of 0%. Now, no VAT is mentioned here, but if it had been, then we would have included it in the consideration price, regardless of whether it could have been reclaimed by Michelle or not. And Michelle, as the purchaser, is the one liable to pay the SDLT. So in total, she's going to be paying £1,200 across the two purchases. There are lots of transfers involving shares or securities or land and buildings that are actually exempt from stamp taxes, so you will need to learn these so you can spot them easily in the exam and let your client know that there are not stamp taxes to pay. We've got the issue of new shares and securities. Remember, we said that stamp duty and stamp duty reserve tax only apply to shares or securities being traded on the market. Outright gifts, where there is no consideration at all, so for example to a charity. So in other words, full gifts. Transfers as a result of divorce or annulment of marriage or judicial separation, variations in people's wills, changes in the composition of trustees, since none of these are going to have any consideration either. Takeovers, reconstructions, where new shareholdings just mirror the old ones, again meaning there's no real consideration amount happening here that can be taxed. Government stocks, unit trusts, AIM shares, that's the alternative investment market. You'll just be told in an ATX exam that the shares are AIM shares, if relevant. And company loan stock other than convertible loan stock. We also have some exemptions in group situations where we have the intra-group transfer of shares between 75% group relief companies. Remember, that's where we have a company and its subsidiaries that it has at least 75% of the shares in, and their 75% at least subsidiaries, and so on, as long as the parent company at the top has directly or indirectly at least 75% of the shares in each of the companies in the group. There is an exception to the exemption for shares being transferred between companies in a stamp duty group, where if the company that is receiving those shares leaves the group within 3 years of that exempt transfer, then it will become chargeable to stamp taxes at that point. There's no impact on stamp taxes if the company leaving the group is the one giving away or selling the shares. The other exemption for stamp taxes within a group situation is the intra-group transfer of land or buildings between companies that are in a 75% group, the same definition as we had before for the group. Now, that excludes situations, though, where at the time the land or buildings were transferred over, there was an arrangement in place for the purchasing company to leave the 75% group. And you need to be aware that if the transferee company, so that's the one receiving the land or buildings, if they leave the 75% group within 3 years of that transfer and they still own the land or building at that time, then that previous exemption from SDLT that they'd received is going to now be payable to HMRC. Now, you do need to memorise these lists of exemptions, I'm afraid, but the most common ones we see come up in the exam are gifts where there's no consideration at all, and transfers between companies in a 75% group relief group, so focus mainly on those ones. There are a few things for you to watch out for with stamp taxes. There's no stamp duty if the consideration amount, so that's the amount paid for the shares, is less than £1,000. This exclusion does not apply to SDRT or SDLT. It only applies to stamp duty. How are you going to remember that? Well, SDLT is very unlikely to ever be on a consideration so small as £1,000, and SDRT, remember, is done electronically via computer system, and therefore it's no real extra effort on collecting the tax on a consideration of £200 as it is to collect tax on a consideration of £200,000. The reason there's this £1,000 threshold for stamp duty is, remember, this is one of the more labour-intensive ones. It requires you to round up to the nearest £5. Stamp duty on £1,000 would be £5. So imagine if your consideration paid was £50 and you're still having to pay £5 of tax on it because you've had to round up. Plus, you've had to fill in and sign a stock transfer form, and HMRC has to process that manual form. That is a lot of hassle for £5 of tax. Now, if you're looking at a capital gains computation, then we can include any stamp taxes paid in the incidental cost of acquisition part of the computation. So we can add the tax paid by the purchaser to the cost of the asset when working out the amount to deduct from proceeds to get the gain. As we saw earlier, you need to make the client aware that there were stamp taxes exemptions applied on the transfer of shares or land and buildings to a 75% group company. If the purchasing company was to leave the group in the 3 years after the date of the transfer, if it still owns the shares or building or land at that point, then the exemption from stamp taxes will be clawed back by HMRC and will become payable. Remember, a stamp duty group is defined in the same way as a 75% group relief group. If we have the gift of land or buildings to a connected company, such as on incorporation, where it's going from being a sole trade business to a company, for example, when working out SDLT, you'd work it out on the market value figure at the time of the gift and not using any actual proceeds figure. And there would still, therefore, potentially be some SDLT to pay, even if the actual consideration value for the transfer of the land and buildings was zero. And finally, if you're working out the structures and buildings allowances for someone and there's mention of an amount of SDLT that was paid by the purchaser of that particular building in question, then you will exclude that figure. Now some exam technique tips for you with regards to stamp taxes. They're not going to be worth many marks in the ATX exam, only up to 3 marks generally, but think how many people will fail one of these exams on 49 and maybe they didn't study any stamp taxes. It could make the difference between a pass and a fail. In the ATX exam, they won't always explicitly ask you to work out stamp taxes and may instead phrase a requirement like, discuss the tax implications of the purchase of the building, which suggests there's more than one tax to consider. So just get into the habit of any time you see the purchase of shares or land and buildings in the exam, spend a minute considering whether any stamp taxes might apply. Also be on the lookout for the disposal of shares, land and buildings, and if there are any of these, then check to see if there's any mention that stamp taxes have been payable at the time of their original acquisition, and make sure you've taken those into account when you're doing a chargeable gains computation. You should make sure that you memorise the list of exempt transfers and assets, as you may need to give advice in a question on whether there are any stamp taxes payable in a particular situation.